Now imagine collecting money even while you're sleeping for the rest of your life. Doesn't that sound awesome? Hello everyone, today's video I want to cover dividend investing, which is one of my favorite investing strategies to sleep well at night. I'm also going to talk about the top criteria you must follow if you look at dividend stocks. I'm going to talk about the biggest mistakes investors make. And most important, I want to talk about actionable tips that you can follow right now. So what is dividend investing? So all it is that you can invest in a stock and the stock will pay you a little bit of money every single quarter for the foreseeable future, as long as you hold on to that stock. So let's use Apple as an example. So you can go out and buy Apple stocks and Apple pays out a dividend. So every quarter, Apple pays you a bit of moolah just for owning that stock. It's rewarding you as a shareholder. Now, why would companies do this? It's because most companies are in the mature stage where essentially they've basically been around for a long time, they have a ton of cash, and they don't know what really to do with it. What's the best thing to do with it? And a lot of times they will reward their shareholders with more moolah called dividends back to you. And how they do this is they take some of their profits and they hand it out to all the shareholders every single quarter of the year, or sometimes they pay out monthly if it's a real estate investment trust. So if you don't own a TFSA or RSP or RESP, you got to open those accounts and start buying dividend stocks to collect some moolah. So if you don't have these accounts open, be sure to check out my links below. You can get $50 of commission-free trades if you open an account with Questrade, or if you want Wealthsimple, check out below. You get $10 for opening an account. And did you know you can buy dividend stocks that grow their dividends every single year? See, Warren Buffett, way back in the day, bought a ton of Coca-Cola stocks. And over time, his Coca-Cola stocks actually pay out 50% of his average cost basis every single year. Warren Buffett collects $600 million of income every single year. And he spent approximately $1.3 billion to buy all those Coca-Cola shares. So that's like over 50%, which is like amazing. It's like saying, hey, you go buy a business for $100,000 and this business pays you $50,000 of pure cash flow, meaning all your expenses have been already paid out and you're just spitting out like a paycheck of $50,000 every single year to you. Okay, so how do you choose dividend stocks? Okay, if you don't want to do any research like looking at growing revenue, growing cash flow, growing earnings, you don't want to do any research, you can just buy exchange traded funds. There's a ton in Canada where they tend to be covering financials or covering the energy sector, but there's a lot of ETFs that you can buy, or you could be a little bit more sophisticated and buy cover call ETFs. And if you want to know more about cover call ETFs, you could check out that video up here. But if you are like me and you like still buying individual stocks because you like having control and knowing what you are investing in and you don't mind a little bit of research, then I'm going to share the top 5 criteria you must look for when investing in dividend stocks, especially in dividend growth stocks. So the first thing you want to look for is, I always stress on buying a company that you know. The reason why you buy a company you know is so that you stay invested, because it's easy to just push a button, put some moolah, and buy a stock, but it's really hard to stay invested. It's like huge on your mindset. So if you know a company and you are confident about the growth of the company, you just know their products, you're just more likely to stay confident investing in that company. So buy a company that you know. Second one is buy a company that grows. And what I mean by that is having growing revenue, growing cash flow. So basically the company is always going to grow so that they grow their profits and then they grow their dividends and pay out more money to you every single year. Because obviously if a company doesn't grow, well, they're not likely to grow their dividends. And then sometimes you may not get a dividend. So that's why I say, please only look at companies that grow, which means growing revenue, growing cash flow, growing earnings. Number 3, look for a company that has a payout ratio of less than 75%. Now you're probably wondering, like, what's a payout ratio? Payout ratio is essentially what percentage of the company's profits is being paid out to you every single year, okay? If a company has a payout ratio, say over 100%, that would be like saying over 100% of their profits is paid to you, which is like amazing. Like, who wouldn't want all the profits from a company? But just think about it. If it's over 100%, that means they're paying over 100% of their profits back to you. How sustainable is that? So that's why I'm saying, when you're looking at a payout ratio, please look for a payout ratio that's less than 75%. All that means is that it's paying less than 75% of the profits back to you, because that's how they pay their dividends, is through the profits. And by the way, if you are looking for all this information, you're like, okay, payout ratio, growing cash flow, growing earnings, growing revenue, you can find that at Yahoo Finance. Or you could go sign up for a free account and you get 10-year financials at QuickFS. Now, this is not sponsored in any way. I just love their website. Number 4, as much as we love dividend paying stocks, what I love even more is when their dividends grow every single year. So the rule of thumb is to look for a dividend that has doubled in the last 10 years. Okay, so if Apple is paying, and I don't know what Apple's paying, actually, I'm just going to make it up. If Apple's paying, say, $2 right now for every share that they issue, I'm going to be expecting Apple to at least double their dividends over a 10-year period. So over 10 years, I'm expecting Apple to pay out $4 for every share that I own. Okay, that's what you want to look for. You want to look for a dividend. If you're looking at dividend stock, look for a dividend that has doubled in the last 10 years. Number 5, look for a company that has a huge track record of paying their dividends every single year for the last 10 years, okay? And most importantly, looking at a time when the market crashed, say like last year. Did they pay out their dividends? Because when you have a company that has a huge track record of paying dividends, even during dark times, like crashes, then it shows the resilience of the company, and it shows how important that dividend is for the company, okay? Because the company has placed a huge importance of paying dividends even during dark times and still grown their dividends, which is like amazing. That's what you want to look for, because we are dividend growth investors, not just dividend investors, dividend growth investors. So we want to be like Warren Buffett, where we own like a ton of shares of like Coca-Cola, and like over like a 30-year period where all of a sudden 50% of what you paid for in that stock is issued to you in dividends. Okay, that's what we want ideally. Okay, that's what we want to look for. That is the dream. So what is the biggest mistake that investors make when choosing dividend paying stocks? What I commonly see, and even like, I'm just thinking back when I was a noob a long time ago, I would like look at the yield and be like, wow, look at that yield, look at the yield, it's like 7+%. And if you don't do your research, you can get a lot of trouble, because that could be a value trap. It could actually like just be temporarily 7%, and then all of a sudden you find out you got like a General Motors or some crappy company where the dividends get cut, or worse, they don't pay out their dividends anymore because they can't afford it. So the way to avoid this is, please, when you see a yield of 7+%, you immediately think, wow, there could be something wrong. Okay, just think of it as like there could be something wrong. So you start peeling back the curtain, do some research, check if the revenue is growing, there's cash flows growing, there's earnings growing. But say that was just too much work because you just want to screen it. The immediate thing you want to take a look at is their payout ratio, okay? If you see a high yield, immediately look at their payout ratio and check. Is it less than 75%? Because we want to know if the company can afford to pay out that high yield to you every single year and grow their dividends, of course. See, the payout ratio is commonly used because it's super easy peasy to use, because it's literally based on their net income, and then they pay out a portion of their net income back to you every single year. So you look for less than 75%. But then when you're looking at real estate investment trusts, you don't look at payout ratio, because they don't have a payout ratio. They look at funds from their operations, which is called FFO. So if you're looking at a REIT, look at an FFO of less than 75%. Or if you're looking at a super capital intensive company like Enbridge, do not look at just their payout ratio, but look at their cash payout ratio, because they are heavily capital intensive, meaning they will depreciate their assets every single year. So their net income, which is their earnings, is going to look like really low. But that's misleading. So with capital intensive companies, look at the cash payout ratio. And that means, please, always strive for less than 75%, because then that means that their dividend yield is sustainable and they're probably going to pay out their dividends every single year. Now, before I share the 4 actionable steps to building your dividend portfolio, please help a Canadian YouTuber out by smashing the like button and hitting the subscribe button and that bell notifications to get every single video coming to you every single week for free, okay? Now, here's my 4 actionable steps to getting you started with building your dividend portfolio. Number 1, if you do not want to do any research where you're looking at buying a company you know, buying a company that grows, and buy a company that makes a lot of dough, which is like growing revenue, growing earnings, you don't want to do any research. That's okay. Just Google search the top ETF companies in Canada that pay a dividend. Just search dividend, top dividend ETFs, and you'll find that the top dividend ETFs in Canada are usually banks. They'll cover the top 5 banks in Canada. They'll also be the top dividend paying stocks in the Toronto Stock Exchange. So just choose an ETF, a dividend paying ETF. And if you choose a dividend paying ETF, make sure you have some that's covering finances, some that's covering utilities, and some that's covering energy, so they get a diversified portfolio of dividend paying stocks. Number 2, if you love picking dividend paying stocks like I do, because you want to absolutely know what you're investing in and having control over your investments, then start with the Canadian Dividend Aristocrat list, which is essentially a bunch of companies that have a huge track record of paying out dividends for a long time and has a market cap of over $300 million, which basically means the company's pretty mature. And most importantly, these companies also have a track record of growing their dividends for the last 5 years, which is like amazing. So I'm going to share a link below of the Canadian Dividend Aristocrat list. Number 3, if you're looking for decent income and looking to grow your dividends and doubling it over the 10-year period, I would start with a dividend paying stock with at least 3 to 4%, which is the starting point. So you could go through screeners and just choose Canadian dividend stocks through the Canadian Dividend Aristocrat list and choose a yield of at least 3 to 4%. It's a great starting point. Number 4, this goes without saying, please do some research. Buy a company that you know, buy a company that grows, and buy a company that makes a lot of dough. So when I'm talking about grow, I mean growing revenue, growing cash flow, growing earnings, so that they can grow their dividends back to you every single year, and look for a track record of dividends doubling in the last 10 years with a payout ratio of at least 75%. And if you're choosing a dividend paying stock in the Canadian Dividend Aristocrat list, then you're probably really safe, because they have a great track record of paying their dividends for at least 10 years and growing their dividends in the last 5 years consecutively. Hey everyone, check out the link below. I've summarized all the key takeaways from this video just for you, so that you have a beginner's guide to dividend growth investing. Also, let me know, what are your favorite dividend growth stocks? Comment below. I want to hear US and Canadian dividend growth stocks. Share below. Sharing is caring. And while you wait for next week's video, please check out these 2 videos up here. This one, covered call ETFs, if you really want to know the pros and cons of covered call ETFs or what they are, check out this video up here. If you want to know more about dividend investing, check out this playlist here.